One of the last topics that will probably be covered in your first financial accounting textbook will be the statement of cash flows. And it is intentionally positioned near the end of your textbook because you have to have a thorough understanding of the income statement and the balance sheet in order to complete the statement of cash flows. Here's a video about a couple nuances that might help you. To test your knowledge of the income statement and the balance sheet and the way that those two relate, your textbook will often not tell you directly information that you'll have to determine indirectly. For example, in this problem here, it tells us that their net income was $91,700, and it tells us that their retained earnings started with a balance of $27,000 and ended up with a balance of $64,000. Well, that means we must have paid some dividends. Remember, retained earnings is an equity account, so it has a credit balance. It started with a balance of $27,000. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. So how much must our dividends have been for us to go from $27,000 plus $91,700 minus dividends to get to $64,000? We must have paid out $54,700 in dividends. $27,000 beginning retained earnings plus $91,700 net income minus $54,700 gives us our ending retained earnings of $64,000. Now in the real world, you'll be able to look in the accounts and see that there were dividends that were declared were $54,700. But in accounting class, they're trying to test you to see if you've learned retained earnings at the beginning plus net income minus dividends gives you retained earnings at the end. Another nuance we'll have to deduce in this problem is how much cash we spent on equipment. It tells us that equipment net went from $49,100 to $66,100. Remember, net means net of accumulated depreciation. At first, we might be tempted to say we spent $17,000. So we take the beginning balance of $49,100, we add the $17,000 that we think we spent on equipment, and we subtract the $15,000 of accumulated depreciation. How do we know we booked $15,000 of accumulated depreciation? Because the income statement tells us that depreciation expense during the year was $15,000. The journal entry for depreciation expense is debit depreciation expense, credit accumulated depreciation. So we credited the account accumulated depreciation for $15,000. Hence, if we assume we only spent $17,000, our equipment net balance is $51,100. So in this example, we're assuming there's zero accumulated depreciation in the beginning, just to make the example more teachable. We have to have spent enough cash on new equipment to not only have the net amount go by 17, but also cover the $15,000 that it went down. So in other words, we must have spent $32,000 on equipment. That takes care of the $15,000 that we went down by recording accumulated depreciation and gives us the $17,000 net increase as it went from $49,100 at the end of 2013 to $66,100. And so in the real world, what you might do is you might look in your account for equipment and look at the debits. That would tell you how much you spent on equipment. But because this is an accounting class, they're testing your knowledge of the income statement and the balance sheet. And they want you to realize that net equipment means the original cost minus accumulated depreciation. You also might want to watch out for instances where they sold equipment. In that case, some accumulated depreciation came off the books when we sold that equipment. That's another trick. All right, I hope that helps.